Okay, good morning. And today is August 1st, 2022, first day of August. I need to do a sound check, so please, if you can hear me, let me know in the chat. Loud and clear. Okay, thanks, Walter. All right. First thing I want to say is make sure you post any questions that you might have. Do it early. That way, I don't come to the end of the broadcast and then I'm not able to answer your questions. But of course, if you do have any questions about the safe wheel and this is not live, please post them in the comment section rather than emailing me or asking me on Discord or anything like that. I'd prefer to talk about the safe wheel within the comment section of the videos. Okay, so let's get started. First, I'm going to talk about the earnings edge. Question is, what happened last week? So last week we went into AMD, and you can see that I made $312. That does not include commissions and slippage, so it's a little less than that. So overall, with the earnings edge, 18 wins, 5 losses, and 3 ties. And since I started only applying the 8 filters and getting a more strict on picking stocks, which is really going to create a situation where there's less occurrences. But there hasn't been less occurrences lately because we're in earnings season. So since we've been applying all 8 filters, I'm 4 wins and 0 losses. And you can see the account value here, $657 over the $5,000 that we started with. And that comes out to about a 13% year to date that we're up 13%. Okay, so that one's doing well, especially since we changed the filters or got more strict with the filters. Okay. And of course that's available, and I did lower the price for that only to $149 a month. It used to be $259, but I know there's going to be less occurrences, so I lowered the price there. Okay, let's talk about the Premier Level 5. This account started with $30,000, and you can see it's down about $500 approximately. The thing I like about the Premier Level 5 is it is truly diversified. So in all markets, it's made for that. We're currently in a grind down market. Now, you guys might be thinking, well, he's down. I'm down on the grind down. That's true. But the S&P had a 19% drawdown, and it's down 8% since inception of this trade system on April 8th. So to compare, instead of being down 19% maximum, this one's down about 4% max peak to trough, and right now down around 1 to 1.5%. But I do see this thing recovering quickly. But like I said, it's diversified. So in all 4 markets, it's designed to make money. So right now we're in the grind down. You can see how we're doing, just kind of treading water. You've got the up market, which we should do okay. Probably will not outperform in a bull market. We won't outperform the market, the S&P in a bull market. But in a sideways market, we'll outperform. And then in a crash, we're definitely going to outperform. The thing is, with this system, when there's a crash or a big spike in volatility, the P&L will drop with the S&P initially, and then it'll recover very quickly, as the S&P sometimes does not recover quickly. This is a great system. This is the one I like the most. And let's see. So we've been doing it, about 4 months now? 3 months? Okay, so let's get into now the safe wheel. Okay. So we have VAC, and we're running the wheel strategy, except for we have a put hedge, which is depreciating, you can see. So last week, we sold a put, and we bought a teeny call, a little $5 call, and we did not get assigned. So we're starting the whole wheel process over again. So this is like starting from scratch. So the question I have is the put hedge, the strike is 25. Is that within 70% of the price of BAC? So the price of BAC is 33.65. So if you multiply 33.65 times zero point 0.7 times 70%, you're going to get around $23 or $23.50. So $25 is higher than that. So we're going to go ahead and stay with this stock and stay with this put hedge. So this put hedge also it has 137 days until it expires. If it was around 100, getting close to 100, that would be another reason to take the put hedge off. Anytime we replace this put hedge, we could move to another stock. And that's what I'm looking to do. I'm not liking BAC so much because there's just not a lot of premium there. It's possible that when I initially went with BAC, maybe it was coming into earnings because it did have a good amount of premium compared to what it has now, but it still has enough premium. But it's just, I think that this system works with a stock that has a little more premium than BAC. It's still working, and it still probably will be fine. But I think a little more premium would be better. But we're not going to switch off. We're going to continue to always use the rules. So here we are at 33.65, and if our put hedge was, let's say, at $23, it would be too far away. It would not be within 70%. So at that point, we would either roll the put hedge up to put it at 80% of this price, or we could, at that point, switch into another stock. So because we're moving out of our put hedge at that point. But our put hedge is still good. It's within 70%. So we're going to go ahead and run the wheel strategy. So what do we do? The regular wheel, normal wheel at this point is to sell a put. And that's what we're going to do. But we're going to do it in the closest expiration, the one that expires this Friday. And we're going to look at the puts over here, and we're going to try to get something 1%. So over $33 is the goal. And you can see here at the 33.50, which is slightly out of the money. So we want to be out of the money and get at least $33, which we can do at the 33.50. And we can get about 38 bucks or whatever we're going to get here. And then we're going to go in and buy one of these, probably the 35 call, to protect our put hedge. Okay, so we're going to sell, and we're going to do one of these because I'm dealing with $5,000 approximately. So we're going to sell one. Maybe we can get $39. Okay. Looks like we're going to get 38 maybe. Okay. So we just collected $38 in premium. And so we're obviously playing that to $38 should depreciate much faster within the week than this $25 put that's further out of the money and further out in time. Because it's further out in time, it won't depreciate as fast. And that's how the system works. All right, so now we need to protect. Okay. So we want to buy something around $5, $6 I'll pay. And this is going to protect our put hedge because if BAC rallies really high, our put hedge is going to lose value very quickly. Let's see if we can get this for 5. I'm going to do 1. Okay, no, $6 should fill. Okay. So now we have our wheel strategy running with our put. So the thing about the wheel strategy is that it is a bullish strategy, and that's why we have a hedge on the put side. So we're protected. Okay, so there you have the earnings edge. So let me go back. So the earnings edge is up 13%. This is up 13% year to date. The Premier Level 5, we talked about that one down about 1 to 1.5. And then we've got our um, safe wheel, which is up about 22% approximately year to date. So that's doing pretty well, doing better than expected. Okay, let me get into, oh, one of the other things is if you happen to not follow me with the safe wheel and you want to go out on your own, there's a flow chart that I put together and I have that available, and there's a link in the description, and I have that at a pretty low price. It's the lowest price that it's ever been, and I'm thinking about raising the price, but I haven't done it yet. Okay, at this point, let's get into answering questions. Let's see what kind of questions we have. So I'm the one who knocks. Casey trades earnings by selling straddles, iron condors during high IV, and they take advantage of the IV crush. Yeah, so um, that's true. You can make money with that, but what happens when, like, Green Mountain, for example, got taken over? So on earnings, well, I think it was Green Mountain, but it was some company, and it happens all the time where they get taken over. So they might be trading at $100 a share, and then they just pop up to $200 a share. Their expected move was $5, and they're all of a sudden at $200 because there's a takeover. You don't want to be short a naked call. Um, I mean, your account, you can get blown out right there just from that one trade. You don't want to put yourself in a position where you can get blown out. And that's what these things do. They make money, make money, make money, make money, and then one time there's one bad situation and they get blown out. So that's why I don't play that particular system. Um, I'm the one who knocks. Why don't you scale the strategy to 50K if it's consistently profitable? I could do that, but I do have most of my money in the synthetic dragon, because that one, my numbers and my real numbers are showing me that that one makes around anywhere from 15 to 25%, closer around that 20% range. That's what it's been doing. And this particular safe wheel strategy does about 10%. So that's why I put my money over there. And that's the synthetic dragon in my hedge fund that has, it's diversified. Okay, Charles. How much drag has your put hedge had on the safe wheel P&L? I don't know. On this particular BAC, $206. Let's see. Yeah, let's go back here. Here's my put hedge, $203 on this particular cycle. I couldn't tell you, I haven't gone through all the cycles and everything. I just kind of track the P&L overall. So I couldn't give you that detailed, but you could go back through the videos if you wanted to and look. But yeah, I hope that answered your question. Walter, obviously one has to buy or sell options contracts in whole number amounts. So when scaling for larger portfolio sizes, are there more precise numbers you can use? For example, 2.7 or 3.2 put hedges. I haven't back tested anything like that. I back tested it with 3 put hedges, and the 3 looks to work. It works. I mean, it does what I want it to do. So I'm not sure how I could even back test that. Like you said, it's in round lots. So I'm not sure I could answer that question. Okay, I'm the one who knocks. Why were you not applying the 8 filters before? Because you're talking about the earnings edge. Because I felt like people were paying money to get a stock at least once a week. I didn't like skipping weeks. I didn't want to skip 2 weeks in a row or something like that, and people wouldn't be getting their money's worth. So I wanted to go ahead and see if I could make it work with 6 or 7 of the filters, and it worked for a little bit, but then it just stopped working. And those were the stocks that gave me trouble. So I wanted to create occurrences, one occurrence a week. That was my goal, and that's why I wasn't applying all 8 filters before. It wasn't all the time. It was just every once in a while when I would not apply all 8 filters. Okay. Charles, according to your backtesting, PL5 lost over 1% in 2013, while the SP surged almost 30%. Can the PL5 not make money in the bull markets? It made money in, if I don't have this backtest right in front of me, but I think it did well in 2021. I know the synthetic dragon numbers. That one did around 26, 27%, the same as the S&P in 2021. But in 2013, I think it broke even or approximately. And the reason for that is because in 2013, there was just no volatility. So the PL5, synthetic dragon, they need volatility to make money. If it's just competing against the S&P in a bull market only, then the S&P is going to win in the bull markets. Okay, Charles. Charles, according to your back test, okay, I think you just asked that twice. All right. Okay, I'm not sure what this is. Alternative investments. Where the comments go? I wanted to hear his answer. So I'm assuming that's why you put 2 comments back to back as the same ones. Maybe it went away for a minute. Okay, I see it now. Okay. All right. I'm the one who knocks. Why don't you wait for the limit order? Maybe it'll fill if you wait 10 seconds or so. Uh, because I'm live streaming and $1 doesn't really mean that much in the scheme of things. So I just get it filled. Even if I wasn't live streaming, I'd probably get it filled anyways. These are very liquid options that we're dealing with. Will, I've had good luck with shop. It's been high premium, but not perfect liquidity. But the profit I have is not even from the premium anyway. It's after you get assigned and then selling the call, and then the difference between the owning the stock, the assignment price, and the uh, strike price when you sell the call. That is where you make the money in this system, most of it. So that's good that you're doing good with shop. All right. Joe, would this work on interactive brokers accounts or TD preferred? Um, it'll work with interactive brokers, no problem. I like TD Ameritrade myself. Would this benefit with portfolio margin type leverage? No, you don't need portfolio margin. It's not going to make any difference trading the safe wheel. I'm assuming you're talking about the safe wheel. Yeah, it won't make any difference. Okay. Will, GME, the meme stock, as others have called it, has good premium right now. I bet it does. That might be an interesting way to go. We'll go from the extreme of BAC with hardly any premium to GME with a crazy amount of premium. I might go with that one next time. As you can see, I've got a nice list here going. And if anyone, you can see the list. If anyone sees like a stock that might qualify that's not on this list, let me know in the comments section and I can add it to the list. Okay, I'm the one who knocks. Do you think the backtest Kager is way off? No, I think it's pretty good. I think it's pretty close to being right on. Got pretty black and white rules. Should be accurate. Okay, Will, do you think you should add a rule to the safe wheel about not starting a position in a stock if earnings is nearby? I've thought about that. Obviously, as I was saying it, I was thinking maybe I should add that rule. Because yeah, I bought an inflated put hedge. That is something to consider, but I don't think it's a problem enough to create a rule out of it. I try to keep things as simple as possible. That's kind of my overall thought right now. All right. So I don't see any more questions. Guys, maybe try to get your questions in. Oh, here's a couple more. Um, and maybe exciting close to earnings if your put hedge goes really high. True. Typically, though, when you sell premium around earnings, most of the time you're probably going to come out ahead when you're selling, and you're going to lose money when you're buying premium around earnings overall. Like I said, though, you can get caught doing that. All right, JD, is it necessary to use TOS to trade the PL5 in order to make trade adjustments? No, TOS. When we're trading the PL5 and we're using the E-minis, the commissions are crazy high. The commissions are actually very reasonable with interactive brokers. Uh, I mean, using interactive brokers might even be better. I just don't like the way they treat margin calls. They're not really calls. They just margin. They go into your account and start selling things without even telling you. I don't like that. But if they didn't do that, I'd be using IB. I mean, they're like 85 cents a contract, where Thinkorswim is like $2.82 or something crazy high when trading options on the E-minis on the /ES. Okay, can you make videos about when you were started trading? Hmm, I do have a couple of videos about what happened to me when I started trading, so I'm not sure if that satisfies that question or not. Thanks for the streams, Carl. Appreciate it. Oh, and that reminds me, go ahead and hit that the like button and subscribe and hit the notification bell. If you don't hit the notification bell, I don't think you will know when these live streams are coming up. Walter, yeah. Click subscribe. Thanks, Walter. Okay, so I don't see any more questions. I'm going to end the live stream, but I am going to say one thing before I do that. And when you're looking at instructors, if the P&L is not real, what else are they trying to conceal? See you guys next week.